In this video, we'll go over my current top 3 Bitcoin covered call ETFs. So I separated these in 3 categories. So first category is for income consistency. What is the best Bitcoin covered call ETF if you want consistency? And then for the second category, which is total returns. If you're looking into investing into a Bitcoin income ETF, but at the end of the day, you don't care as much for the income and you want your total returns to be as close as possible to the Bitcoin's actual total returns, we will be looking at BITO, which is pretty good at replicating Bitcoin's total returns. And then finally, the last category would be if you're someone who wants to go all in on income, all that you care about is getting as much distributions month after month or week after week. We'll be looking at this Granite Shares YieldBOOST ETF, which is, as you can tell in the name, is all about maximizing your income and getting the highest yield possible. Alright, let's start by the consistent ones. So I'll talk about BTCI and BAGY, which are basically side to side and they're very similar. So I want to cover these real quick. So for BTCI, I don't think this one needs much of an introduction because it is very popular in the Bitcoin as well as the income investing space. But for people who might be new to it, or just to give a little recap, so this is NEO's Bitcoin high income ETF. And what's particular about this one is that they offer similar returns to the Bitcoin and high income by using synthetic exposure. So that is kind of their own twist to it. And what's very nice and what's very loved about this one is that it's been doing very well on terms of capturing as much upside as possible, considering that this is a covered call ETF. As you can see, the distribution rate is around 28% right now. I think that this is pretty conservative considering the IV of the Bitcoin. So what are the target benefits of this one? So they say that it seeks to distribute monthly income generating from writing covered calls on Bitcoin futures. So what they're doing here is they give you exposure to Bitcoin, and instead of generating income by writing covered calls on a Bitcoin ETF, like for example IBIT, they write their covered calls on Bitcoin futures. At the end of the day, this is pretty similar to writing covered call on Bitcoin ETFs, but I think that futures is more volatile and it's kind of a more direct way to have exposure to the price movement of Bitcoins. And then it says actively manage. The fund seeks to offer upside potential via efficient exposure to Bitcoin traded products. The fund implements a data-driven call option strategy, saving investors the time it would take for you to do all those covered call trades, as well as potential expenses. So this is just a hands-off option, and they're just saying that they're kind of a hands-off solution for people who trust covered calls and kind of understand how they work, but they don't want to go through the hassle of learning them and doing them themselves. The market performance since inception is 48%. This fund is still pretty new. As you can see, their first distribution was paid on October 24 of 2024. What I was saying about this one, for consistency, the distribution amounts per share have been fairly consistent. It is a bit variable, which is normal because they're selling covered calls at the end of the day on an asset like the Bitcoin, which is super volatile. But they've been doing a fairly good job at maintaining a yield that is around 25 to 30%, as you can see. They pay 147, 139, 151. Then during the April crash, 125. As we know, the Bitcoin itself has been going up as of recently. And as we can see, the distributions have been following the movement of the Bitcoin. If we look at their prospectus, like I was saying, they do synthetic covered calls. They kind of summarize what they're doing. So they say that the synthetic exposure is created through the combination of purchasing call options and selling put options, generally at the same strike price, with the same expiration. So that means that they're buying a call at $100 and at the same time they're selling a put at $100, and that's how they get their synthetic exposure. They do that instead of actually buying a lot of shares of IBIT, for example, which could be very expensive. A deep in the money call gives you exposure to the price movement of the underlying without having to pay the full price for the shares, and then they pay you those distributions by selling those puts. If we look right now at their top holding, as you can see, they're holding treasury bills. This is just cash and it's needed as collateral for their option positions that are open. Then you have straight exposure to Bitcoin here from the HODL ETF, which they only have about 24% weight in the portfolio. And then as you can see, their synthetic exposure. So they are holding these in the money calls for the exposure to the price of Bitcoin. So here, for example, they're holding a call that expires in October of 2025 for $254. So they have 10% of that. And that's how you get that exposure to the price movement of the Bitcoin. And then they generate income by selling those options as well. So here, as we can see, they're selling a call at 285 and they're selling another call at 272. And they're also selling a put here at the same price of that call for 254. So that's what they're saying in their prospectus, and this is how they're generating income. So now if we give a quick look at the performance of BTCI versus IBIT. So IBIT is just the Bitcoin itself. It's just an ETF holding Bitcoin from iShares. As you can see, the performance is pretty similar. BTCI is following IBIT, but there is a gap, and obviously when you're investing into a covered call ETF, you're going to limit your upside. And that is essentially what is happening here. So when the Bitcoin has a good push up and when the Bitcoin is in a big rally, as you can see, BTCI is going to fall behind. At the beginning of the position here, they were pretty much side by side. And then as soon as Bitcoin flew up, BTCI was not able to keep up because, again, they're doing covered calls, so they're limiting the upside. So that's the downside of this one, is that when the Bitcoin is going to rally, you're going to be missing out on some gains in exchange for income. As an income investor, I think that you would know the risks of holding a covered call ETF, which is limited upside. For the second one that is quote unquote stable, so what is BAGY? So BAGY is another covered call ETF very similar to BTCI. This one has a different strategy. Max income focus, BAGY seeks 30 to 60% annualized option premium and Bitcoin price appreciation, potential up to 5% each week. So that means that they already tell you in advance how much they're capping the upside. So BAGY is very good as long as Bitcoin doesn't go up more than 5% a week. You will be getting all of the upside of Bitcoin plus income, 4 times more options. So they use weekly call options and then harvest volatility. When Bitcoin price volatility rises, BAGY's option income potential increase. Obviously, this just means that when the IV of the Bitcoin goes up, they're able to generate more option premium. And that's the same thing for BTCI. Anyone who's trading options will make more money when the market is more volatile and the IV is higher. Here, as you can see for the distributions, it's been very stable. And I think this one might be even more stable than BTCI, since this one has the same strike price over and over and week after week. They basically explain you exactly what they're doing. And I think this is actually very, very cool. And this is going to offer a very good stability. And this might outperform BTCI in the long run, but that we'll have to see. So what they're doing is they buy Bitcoin for actual exposure, and then they sell covered calls, same way as BTCI, but here they tell you exactly what they're doing, and they're selling their calls 5% out of the money. They have a specific strike price every single week. They're going to aim for a strike price that is 5% higher than the current strike price of the Bitcoin. Also, what they're doing is that they're selling those calls on 100% of the portfolio. 100% of your holdings will be covered by those covered calls, and they're going to be aiming for a strike price that is 5% above. As long as the underlying doesn't increase more than 5% in a single week, you're going to maximize your income and maximize your return. But then if the underlying, for example, goes up 10% in a single week, then if you hold BAGY, you'll only gain 5% plus income. Since they always have the same strike price, depending on the implied volatility, month after month, you should be seeing very consistent distributions. Since this one came out in May, we don't have as much data to look at the total returns. But here, if we compare BTCI to BAGY, as we can see, BAGY has been doing actually a better job at capturing upside. And the total returns for BAGY is slightly higher than the total returns from BTCI. So the annualized gain for BAGY were up 92% versus 83%, so there's a 10% gap. And on a total return perspective, so over those last 2 months, we're up about 1.5 to 2% more on BAGY's side. I think that BAGY in the long run might actually end up doing better than BTCI, but that really depends on the performance of Bitcoin. If Bitcoin really rallies more than 5% every single week, then you might get stuck with BAGY. So for the sake of the video, for the consistent one, we're going to go with BTCI. When we get more history with BAGY, I'll make another more in-depth video on BAGY and probably compare BAGY and BTCI and see which one could be better, depending on which type of investor you are and what you're looking for. Now let's look at BITO, which is total returns. So here, as they say on their website, BITO aims to produce returns that correspond to Bitcoin. That means that the managers of BITO are trying to make the total returns of this ETF as close as possible to someone who would just be holding Bitcoin without income. So the total returns of BITO, which means price plus distributions, should be the closest one to Bitcoin. Why BITO? First US Bitcoin linked ETF. So one good thing about this one is that it has the most history. It's probably one of the oldest one, or here it says it's the first one, so this one has a lot of distributions, a lot of price movement under their belt, familiarity, liquidity, and transparency of an ETF, available through brokerage accounts, whatever. And then here, investment objective, like I was saying, BITO seeks results before expenses and fees that correspond to the performance of Bitcoin. So really, the goal of BITO is not to have the highest income, the lowest income, the best price appreciation. Price plus distributions is as close to Bitcoin as possible. The way they do that is without even trading options. Here it says that BITO invests in futures and swap and does not directly invest in Bitcoin. There is no guarantee that the fund will meet its investment objective. Obviously, you can't guarantee that BITO is going to match Bitcoin because it's not Bitcoin. Now, if we look at the holdings, we can see that they don't hold any Bitcoin. Their biggest holding is the Bitcoin futures, so CME Bitcoin Future Digital Asset. And their second biggest holding is the Bitcoin swap. This fund does not generate income using options. They don't trade any options. They don't do any covered call. They're able to generate those distributions from that swap in the futures. So how does that work? Is basically a swap agreement is like a contract between the ETF BITO and a given financial institution. In this case, I think that it is Société Générale here. Society General takes care of doing their thing on their side, and then whatever they're able to get as returns, they'll give them back to BITO as money, and then BITO will take that and pay it back to their investors as distributions. Essentially what it is that it's the same as holding the Bitcoin, and as soon as you get a big move to the upside with Bitcoin, it's the equivalent of selling shares and using that as distributions. On the months where the Bitcoin is going to move up a lot, you're going to see big distributions. And on the months where the Bitcoin goes down or is sideways, you're not going to see high distributions because they're not trading any options. So you rely on the performance of the underlying. So you will get big distributions when the Bitcoin goes up, and you will get small distributions when the Bitcoin goes down or sideways, compared to BTCI, where covered calls is depending on the implied volatility and not really on the price of the underlying. Here, if we just look at their distribution history, as I was saying, the distributions are very variable and they really depend on market conditions. Those distributions plus the price of BITO should be as close to the Bitcoin as possible. In April, everything kind of crashed. There was a big market correction and Bitcoin also went down. And then as you can see, Bitcoin went down and we got a small distribution of 36 cents. And then markets started to climb again. And as we can see here, as it moved up, we got 54 cents. Then here in June, it spiked, it got 99. In July, it went down a little, so we got 77 cents. And then in August here, we are about to get a distribution of $1.20. Bitcoin, Ethereum, a lot of cryptocurrencies really went up in the month of July. That is why we're seeing a big distribution for August distribution of BITO. As we can see here, if we look at the growth of $10,000 with dividend reinvested, which means total returns, BITO is very, very close to the Bitcoin compared to BTCI that we saw earlier. Now here, just for fun, if we compare BITO and BTCI, as we can see, when the market rises super fast, BITO obviously is going to outperform because basically BITO is not capped on the upside, and whenever the underlying, which is the Bitcoin, moves up a lot, BITO is going to pay those huge distributions to match the total return of the Bitcoin, where BTCI is always going to pay you a certain amount, and the upside is going to be capped from those covered calls that they are selling to generate income. As we can see, when the market goes up, BITO is outperforming, and then when the market is sideways, they get closer. As long as the market keeps going up, BITO is going to outperform. And obviously, if you're bullish on the Bitcoin and you don't care as much for income, we haven't seen a moment yet where in terms of total return, BTCI was doing a better job than BITO. Just to showcase a little bit how the swap works, here if we look at the distribution of April, so this distribution was based on the performance of the previous month, so it was pretty much based on the price movement of Bitcoin during March. March was pretty much a red month for the Bitcoin, so hence that is why BITO paid a super low distribution. And then for example, if we look at the distribution that was paid in June, so that was reflecting the price movement of May. The price of Bitcoin went up all the way to 15% during the month of May. That is why we got a higher distribution. Just to repeat myself again, that swap that is paying those distributions for BITO, they're basically paying you back those gains. So it's kind of similar as actually holding IBIT, and whenever it goes up, you sell some shares and you use those as distributions. So you will get better returns when the market goes up, and your upside is not going to be capped like covered calls, but you're not going to have consistent income. And when the market goes down, or if the market is sideways for a long time, then a covered call ETF is going to outperform BITO by a lot. Now for Granite Shares YieldBOOST Bitcoin ETF. This one is also different from the two other ones that I showed you guys, so BTCI and BITO. So for product overview, they say that Granite Shares YieldBOOST Bitcoin ETF XBTY is designed to generate income from option strategies linked to 2x long Bitcoin daily ETF. First of all, the reason why they're able to generate twice as much or a lot more income the two other ETFs that we've seen is that instead of selling calls, they're selling puts. And second of all, they're doing so on a 2x Bitcoin leverage ETF. So the IV is going to be twice as large as the current Bitcoin IV, since the implied volatility of their 2 times Bitcoin underlyings is going to be twice as high as the normal Bitcoin. Whatever they are doing with their option strategies, they will be able to harvest a lot more income than selling covered calls on a normal 1x Bitcoin ETF, for example. Another thing that is cool about this one is that they pay weekly. So for anyone that is a fan of weekly distributions, this one could be very interesting. On top of paying a high yield of 80, 90+%, they are paying those distributions on a weekly basis, 47, 47, 47. Those past 4 or 5 distributions have been very stable. And then in the past, they've been higher. So I'm not sure if they've been adjusting their strike prices and things like that. Now for the fund objective, the fund's primary investment objective is to seek income. This one is all about income maxing. It's not about total returns. Obviously, the total returns of this one is going to follow the Bitcoin. If Bitcoin is going up, since you're doing all of these things on the Bitcoin with this ETF, you will trail behind Bitcoin's returns. But the primary objective of this fund is to pay as much income as possible to the investor. And then as a secondary goal, probably like you do have exposure to Bitcoin. So if Bitcoin is on a super big bull run, you might be able to catch a little bit of that, but it's not like you're holding BITO or BTCY where it's going to be very, very close to Bitcoin. This one will be more choppy in terms of returns. The fund's secondary investment is to seek exposure to the performance of obviously US regulated exchange that seek daily leverage investment on the Bitcoin 200%, whatever. So basically the first objective is income, yield boosting, whatever you want to call that. And the second objective is exposure to the Bitcoin, but here they just specify that it is exposure to the 200% Bitcoin and not the regular Bitcoin. If we look at all the ETFs that are available from Granite Shares, they have a lot of 2x ETFs on a bunch of single stocks, but unfortunately they do not have a 2x ETF on the Bitcoin, or else it could have been interesting to see them use their own 2x Bitcoin ETF inside of XBTY. We could probably save a little bit on management fees from their own ETF plus the underlyings. Here, if we look at their top 10 fund holdings, they have 50% cash, then they have 50% treasury bills, and then all the rest of their holdings are option plays. Now you might wonder, what's the point of selling puts instead of selling calls? So essentially it's very, very similar to selling calls. You're selling puts and you're getting the premium right away instead of selling calls and getting the premium right away. Here I asked ChatGPT to give a quick summary of what would be the advantages of selling puts instead of calls, just to understand better. So first point is more bullish bias, profits if the stock stays flat or rises, better suited for mildly bullish outlooks. If the underlying goes up a lot, the fact that you're selling puts, you might be uncapping the upside a little bit compared to selling calls. Then lower volatility exposure, selling puts typically has less sensitivity to sudden market drops versus covered call, which caps the upside. No need to own the underlying, and I think that's the biggest point. To sell one contract of a covered call, you need to own 100 shares of the underlying, or else you can't. The thing with selling puts is that you do not need to hold. All that you need is you need some cash as collateral just in case. So here the ETF doesn't need to hold the stock, reduces capital tied up in shares. They can deploy more capital into the options, and they don't have to hold actual shares of those 2 times BTC ETFs. They can collect premium with cash collateral. So instead of holding shares, their requirements is to hold cash or short-term treasuries as collateral. And as we see here in their holdings, that's exactly what they're doing. Almost 100% of the portfolio is cash and US treasury bills. In case they get assigned and their options get exercised, they need collateral. But other than that, they don't need to actually own any shares. Often better in rising or sideways market, retains full upside if the stock rises, unlike covered calls which forfeit gains above strike price. So here you're not limited to a certain strike price, since you're not selling a call at a certain level. You can get all of the upside. And here for any downside compared to covered calls, I guess this is kind of the inverse of calls. You have more risk in drawdown. So if the Bitcoin drops a lot, you might be forced to buy Bitcoin at a lower price than it actually is, kind of like the covered calls. And no dividend collection, since you don't actually hold the shares. You won't be getting dividends. We don't care about that because Bitcoin doesn't pay dividends anyway, so this doesn't apply to us. When we compare the total returns of XBTY and IBIT, this fund is still pretty new, so I'm thinking of making another video on XBTY in a few months, in a few weeks when we get more data. We can only start looking at the data from May 13 up until now, regardless of the fact that all of their options is on a 200% Bitcoin ETF. They're still able to trail and follow the regular 1 times Bitcoin total returns. When there's a sharp move up on the Bitcoin, it seems like XBTY is trailing a little bit. And when Bitcoin is basically sideways, it seems like that's where XBTY is rising. As you can see here, the Bitcoin has been a bit sideways. XBTY has been able to keep going up. The underlying doesn't go down, then the price of XBTY is going to stay relatively flat while they keep paying those very high distributions of 80, 90, 100%. This one is all about income, like I said, and like we just saw, the total returns can be very close to the Bitcoin. But even though it has a high distribution rate, as we saw, to consider the total return of this one, you need the income. Since the yield is so high, the price itself is not going to be able to rise as much as the Bitcoin. So as an income investor, if you want to use this one to maximize your income, you have to be conscious about the fact that you'll need to invest a large portion of your distributions, or else you will just be eating out of the returns and you're not going to let this investment grow. Here what I did is I extracted the distributions from October 2024 up until now for BTCI and BITO. And then for XBTY, since we don't have much data, I got all of the distributions since the inception of the fund and since they paid their first distribution. So as we can see here, BTCI, from their first distribution here in October, they were at 48 bucks. And then right now they're at $62. So with BTCI, they pay a consistent and conservative yield of around 28, 27%. And they do cap the upside, but you'll be able to get some gains on the price of your investment on its own. And then when you add the distributions, that's where you get those total returns that are close to the actual total returns of the Bitcoin. So the average is 29.2%. And the median is 28.6% for the yield of the distributions. And the standard deviation is 2.16%. And month after month, you shouldn't be seeing more than a 2% difference with your yield. So that means that if you're someone who needs the income, if you're someone who's planning to retire, or you're someone who's trying to budget and kind of use 30% of your distributions to pay for a few bills or whatever, with this one, you will be able to have a consistent budget. When it comes to BITO, these guys, they pay based on a swap agreement. So essentially, they pay you back the market returns. If the Bitcoin moves up a lot in a month, it's kind of the equivalent of selling your shares that are in profit and using those as distributions. So these distributions will vary a lot. On months where Bitcoin is flat or goes down, you will have smaller distributions. And on months where the Bitcoin rises very fast, you will have some higher distribution yields. In October of 2024, we got a distribution yield of 73%. Then we got 57, 46, 57, 48, 43. When the Bitcoin crashed during March, April, we saw a distribution rate go down to 25%. Then go back to 32, 57. It's very variable and it really depends on the price of the Bitcoin. And if Bitcoin moves up a lot, you're going to have high distributions. And if Bitcoin is flat or goes down, you're going to have smaller ones. The average here is 48 and the median is 47%. But then the standard deviation is 13%. So this one will allow you to get total returns very close to the Bitcoin, with a little cherry on top being income when the Bitcoin does very well. And then for those income maxers and people who just love to have the highest yield, or maybe you just want to have a little bit of a yield booster in your portfolio to use to buy some more stable assets or to buy Bitcoin or whatever you want to do, they pay on a weekly basis and their yield has been 97, 128, 128, 106, and now as of recent, they've been 95 to 100%. Here the average is 105%, the median is 98%. And the standard deviation is 14%. Here, the expected yield on a weekly basis might be around 84 to 110% based on the standard deviation. Since they're making income by selling puts instead of calls, I want to see how a correction on the price of Bitcoin would affect XBTY. This might be a good one for Bitcoin exposure and high income in your portfolio, but you have to be careful because they are doing that on a 2x leverage Bitcoin ETF. You have to be comfortable with a lot more volatility in your portfolio on top of Bitcoin being already volatile. At the end of the day, it's all about preference. As you can see, they are all very, very close to each other in terms of total return. If you want consistent income, if you don't care much about income, then maybe BITO is better for you. And if you want to maximize your income in your portfolio and you want weekly distribution, then XBTY seems to be like a strong pick, but this one is still about income and is leverage, so we have to be a bit careful about this one in my opinion. If we look at the YTD here, everything is still very, very close. A covered call ETF is going to do better on a choppy / sideways market than an ETF that is paying off a swap agreement. But in the moments where the Bitcoin rises fast, BTCI is going to be capped on the upside and BITO is going to outperform. So it really depends on the market conditions and when you invest. Here, if we look at the 1 month chart, for example, then it looks different. As you can see, BITO and the Bitcoin are essentially side to side. And like I'm saying, with BITO, the upside is not going to be capped. So when the Bitcoin does very, very well, you're going to be outperforming. As we can see here, after the big spike here, the price of Bitcoin has been going sideways and down. And BTCI is slowly catching up. And now it's almost the same thing as BITO and IBIT. So something like XBTY might be outperforming if we end up in a period where Bitcoin stays flat for a few months. Then we might see XBTY have crazy total returns. In my opinion, if you want a consistent ETF, I think that BTCI is the clear winner. BAGY has a lot of potential, but is still very new. Then if you're all about total returns and you want to invest in the Bitcoin for the long term and you think that Bitcoin is going to rise a lot and you do not want your upside to be capped, then BITO might be the better choice. And if you just want to boost the yield of your portfolio, then you might be interested in looking into XBTY. I will put the link of all of these ETFs in the description of the video. So let me know in the comments if you own any of these. Maybe some people own some Bitcoin ETFs that I didn't mention in this video. So I'm curious about that. Let me know in the comments if there is any other Bitcoin income ETFs that you're holding and I didn't mention in this video. Until next time, take care, guys.